crazy story. So I get a phone call one day, and let's just call this individual Zelda. So Zelda calls me up and she said, Paul, can you get me a mortgage? And I realized pretty quickly that she actually worked at a financial institution. So they get staff discounts, and she is probably really good friends with all the mortgage specialists in-house. So why was she coming to me? Well, it turns out that even her own financial institution wasn't going to give her a mortgage because her credit score. And that was just one of the many factors. So what was really interesting is I told her, well, why can't you be accepted in-house? And I mean, didn't you plan this beforehand? She said, yes, well, I went on one of those free financial credit score check websites, and it said I was fine. It's Paul, and she said to me, Paul, we have spent the last 5 years planning for this, saving for down payment. We're about to get married, my fiance and I, and there's no way this could be something that's going to turn us down. Please, I mean, we spent so much time viewing homes. We're stress planning the wedding. Is there anything you can do? And I told her, right now there's not. Now in this video, you're gonna learn how not to be Zelda by following 3 simple but super major components that you can plan for so you don't get surprised last minute. What is your minimum down payment? What's the balance of your debt and your income for everyone in the application? And lastly, we'll talk more about what happened to Zelda and how you can make sure that not just your credit score is in check, but your credit story.
Hold up.
We're going to talk about some basic rules of thumb, broad strokes on just how to make sure you have the right gut check to see if you're even on the right track with the most important aspects that lenders look at, because at the end of the day, you don't want to be foolishly turned down by a lender, and I feel like they get pleasure in turning people down. I mean, one quote I love from Steve Martin is that just be so good they can't ignore you, right? So when it comes down to that showdown, if you got your stuff figured out and you've just done some really basic pre-planning, it's going to be a lot less painful to get a mortgage. So let's make sure that you know exactly what to do. Now don't worry. You're not getting a PhD in mortgage financing here. No, not at all. You're gonna learn some really basic rules of thumb just to make sure that you're on the right track, and that when it comes down to getting your mortgage, it's gonna be a lot less painful. Now there's a myth around 5% down being only applicable for first-time home buyers in terms of down payment. Now that's not the case. If your home is $500,000 or less, then yes, you can do 5%. But, I mean, if you live in Vancouver or Toronto, then you probably got to put down more. So the way it works is that the first $500,000, you put down 5%, that's $25K. Now if your home is worth let's say $900,000, between $500,000 to $1 million, you do 10% of that. So what's the math? You've got the $25,000 for the first $500,000, and you take $400,000, which is the delta between $900 and $500. You take 10% of that. So in total, what do you got? $65,000. That's the way that you calculate the sliding scale. And lastly, if your home is over $1 million, minimum 20% down. And once you get into $2 million territory, then there's a sliding scale, and it ends up being usually closer to 25 or 30% down. Lots of people have problems with minimum down payment. I get it. Life is expensive. Our cities are more and more expensive, and there's just a lot of costs out there. And hey, not to mention, when you close on a property, you need to save an extra $10,000 to $20,000 just for closing costs. Save early and cut your discretionary spending, all based on an end goal. I mean, it's just like as if you're planning a trip, right? I'm gonna go to Oaxaca, Mexico for the best mezcal in the world. Am I gonna book my flight and hotel first, or plan out the restaurant and end up and plan some day tours, or let's say meeting people? Now, let's say I do the latter first. So I book a bunch of restaurants, and I maybe even plan some dates out there, and the restaurant and the dates are 30 miles in opposite directions of the hotel. That makes no sense, especially given that there's a lot of expenses that you're going to have along the way, and also it's a steep saving goal, so you've got to start today. Now, if you're thinking, Paul, I know how to do basic budgeting, I can't save $25, $30, $50, $100,000 in as short amount of time as that I want a house. So what I do? I get it. There are other ways to do this. So the biggest thing that I see probably in almost a quarter of the cases are that people get gifted down payments. So what that means is that you can get a gift from a direct family member, and as long as they sign off and say that you don't have to pay it back, then yes, you can usually use all of that sometimes for your down payment. So the next time you have a family dinner with Aunt Viv and you don't really want to be there, be extra nice to her. Although, side story, I had a client where she had a really awesome aunt. They were very close, and she's going to offer to pay their down payment. But that specific lender we got her approved with said it wasn't blood related enough, and they turned it down. So you also have to understand, how do the different lenders define what is the right kind of blood related family member for your gifted down payment. So how does all this actually get calculated? So usually it's called GDS and TDS debt service ratio. That's nerd mortgage talk. Really what it means is it's this balance of debt to income. Now, I really recommend you talk to a mortgage broker around the exact calculation, but rule of thumb for you is you take 5 times the household gross before tax income of people who are going to be on the application, and that's how much mortgage that you can afford, okay? Now, that's assuming you have no debts. If you have debts, every $400 car loan payment that you have to make per month, that deducts $100,000 of eligibility to the first part of the equation. Now, if you have every $13,000 of actual credit card loan, you don't pay that per month. It's just outstanding. That's the equivalent of also having $100,000 less of mortgage eligibility. We've got Princess Peach and we've got Wario, and they both make $45,000 combined. That's $90,000. They want to get a $500,000 home. They have 5%. Generally speaking, at this point, you would be screwed. However, what sometimes people don't realize are there are other additional ways to boost their income so they can get a little bit closer to that threshold of what they need. Let's dive into those. So let's say that you're short $25,000 in this example, right? We talked about gifted down payment. If you've already exhausted that option, the next thing is actually you can get money lent to you by the government to cover part of your down payment. That we can talk about in another video. But there's those options. Now the next thing is there's child tax benefit. So basically the way it works is, as you know, you get a certain amount of money per year for children under 18. So the way this works is that if you get a 5-year term, however old your kid is, by the time the 5-year term is over, they cannot be over 18. So make sure you do the math on how old they are right now and how old they will be when your term is over. That's another way of adding part to your income and helping you get more eligibility. Now this one I hear a lot about, and people ask me, hey, what if I have rental income in the unit that I'm moving into? Totally possible, but a few caveats. Firstly, not every lender will actually take all of your rental income into the calculation that we're doing. Secondly, if the people that are renting from you and giving you income, if they're rooming next to you, that doesn't count. They have to be in their own, what we call a legally contained suite. So what that is that they have to have their own entrance, their own bathroom, and their own kitchen. Other ways of boosting your income are getting a cosigner. The same math applies. We get their income, their gross income per year, and add that to your sort of equation. Keep in mind though, if they have a lot of other mortgages and debt, that may do more harm than good, so do the math there. And lastly, if you have a side income or a side hustle, that income can be used, but the catch is, at least in most lenders, is that you have to average out the last 2 years of income, and that usually can be added on as bonus income to your application. Now, before we wrap up with our final point, if you enjoy learning from people's misery, and or you think this has not been a total waste of your time, then please hit the like and subscribe button, because God, one day we need to be ahead of more cat videos on YouTube. That's our dream, and you can help us get there. Now, the last thing that really catches people off guard is, as I said at the beginning of the video, it's credit score. And not just credit score, it's also your credit story. So back to the Zelda example, they got their credit score from one of those free websites, which was not accurate enough. When they got their official score, they were below the 600 absolute minimum threshold. If you have under 20% down, you cannot be under 600, at least at the time of this recording, okay? So that's the first thing you really gotta make sure is dialed in. Now, Secondly, credit story. And let's go back to the example. Remember the girl who had her aunt, right? Her aunt that gifted her money. Now the other issue was that her boyfriend, he actually had a pretty good credit score. It was in the mid 700s, but he still got turned down because he had something called thin credit. So what's thin credit? Well, just the way it may sound, there wasn't enough of him actually using his credit cards. You see, the lenders don't really see it that way, and I kind of get where they're coming from. I mean, basically, you've got to have some street credit and spending money and paying it back, especially if it's not yours. So, I mean, another rule of thumb for you, it's the 2-2-2 rule. And basically, the way the lender sees it is that, look, you've got to have at least 2 trade lines, which is just like a line of credit and or a credit card that you've had for at least 2 years, and each has to have a balance, an available balance you can borrow from of at least $2,000 each. So if you have that going on, then generally speaking, that is enough for you to not have thin credit. Of course, you got to pay back on time. That affects your credit score. But the thin credit part is you've got to make sure you're using credit. Really, really important. And just on a side note, especially if you have declared a personal bankruptcy or consumer proposal, this rule applies after you've paid it off and you're discharged. And another side note is some lenders want to wait 7 years until you have been discharged. So if you get called by one of those companies and say, hey, you want us to get rid of a bunch of your debts and suddenly you'll owe less, you just have to sign these papers to get a consumer proposal, do it only if absolutely necessary. Don't do it because it's free money, because once you start to realize that you're out of the market for 2 to 7 years, I've seen so many just terrible situations from that. Even people who had $10,000, they just wanted to turn into $2,000. There is a big cost there in being priced out of the market or having to go with a private lender. So please, on a side note, make sure you stay away from those, unless of course you're advised to do so and it makes sense. Now another client that I worked with recently, let's call him Ganondorf. Ganondorf, he paid his bills on time. He definitely used enough credit, but he didn't even have a credit score, actually. He didn't have thin credit. He had 0 credit. Why? Because it was all done under his business account. And I've seen that on more than one occasion. So make sure if you have a side business, whatever it is, you've got to take on some debt personally, because the business credit score is not going to translate to your credit score. So that's something that for those entrepreneurs, make sure that you are still following the 2-2-2 rule. So before you get back to your busy and important lives, playing lots of N64 like someone in this room, or planning a trip to Oaxaca, Mexico, just understand that just like in any video game, if you want to level up and not stay stuck and pay rent forever, there's these 3 really important pillars that even if you are a year or more away to having to really think about, you never know. So remember, down payment, debt and income balancing, and your credit story, not just your credit score, are like really important things that you should have at least a basic gut check on right now, because you do not want to end up like Zelda or the girl of the end, or just people that, smart people, well-intentioned, they just learn this stuff a little bit too late. And some of these things literally take 6 months to a year to course correct. So make sure you know where you stand, know the rules of the game. Those are really important for you to level up. So what are your next steps? Well, now you are very well equipped to know the rules of the mortgage game. Talk to your local mortgage broker, or even just do it yourself. In the links in this video, there will be a couple references on how you can just start to do it yourself. And if you know someone who is either passively or actively looking at house listings, please flip them over this video just so they know where they stand.